Yes, I know the message isn't pretty, but we want to hear more about it.
Thank you. Sorry, go ahead, please.
I was going to say, one of the biggest threats to the global economy, you say, is inflation. The report makes that very clear. It's hurting. There's a cost of living crisis globally. It threatens economic global stability. You think inflation is going to hit 8.8% this year. But you say central banks have to go after it. They have to fight it, even if it worsens the slowdown in the economy. So how does this work out?
So clearly, inflation is rising across the globe. You can see that very high in advanced economies. Even in emerging markets, it's rising quite sharply. So it's important for central banks to address inflation head-on. So I think it's important, because otherwise you risk losing credibility. Inflation expectations could get unmoored, and so on. So I think it's very important that they address inflation head-on by tightening policies. I think that's true for advanced economies. That's true for Asia too.
Well, of course, one of the big problems here is the impact of the strong dollar on even on the Bank of England, right? I mean, it's one of the things, one of the threads that connects to what's been happening there. But certainly for emerging markets, there's plenty of those in Asia. The threat of higher debt financing costs, which the poorest nations certainly can't afford, and weaker currencies. We see the BOK doing a 50 basis point rate hike. What do you recommend there? Is that just something that we have to live through for now?
So I think what you're seeing in terms of the depreciation of currencies in Asia, it's reflecting two things. One is, of course, the terms of trade impact from the war, and second, the interest rate differentials because of the different stance in monetary policy between advanced economies and Asia. So Asian central banks didn't have to tighten so much in 2021 because inflation was pretty muted there. But come 2022, you can see inflation has risen quite sharply. In fact, core inflation is about central bank targets for many countries there. So they have to tighten interest rates. The question, of course, is, what does depreciation mean for these countries? And what we think is there could be an impact of greater pass-through to inflation from depreciation, which needs to be addressed head-on through the interest rate cuts. Of course, what this also means that with growth slowing, depreciations and interest rate increases, debt, which has risen sharply in Asia, could come to bear upon prospects in the region.
Well, China's weakening economy, you say, is one of the biggest downside risks to global growth. And of course, there's two parts: the impact of the lockdowns, the weakening property sector. That just doesn't seem to get better at all. And of course, there's the question of what does it mean for the global economy, but in particular, what does it mean for Asia? Again, when I mentioned with Korea, they've already seen their exports weakening. This is a big driver for the Asian region.
True. So we have marked down a forecast for China, modestly so this time around, but that basically reflects two big factors. One, of course, the zero COVID strategy and the repeated disruption because of that. And the second, which comes because of the stress in the real estate sector, which remains unaddressed in any meaningful way. So both those factors are bearing upon activity in China, and that has significant implications for the region. Intra-regional trade is about 50% in Asia, and a large part of that is China. So if China slows or if downside risks in China increase, it'll have a significant bearing on the rest of the region.
Krishna, it's Yvonne in Hong Kong. Thanks so much for joining us. I think based on your forecast, you guys are projecting that maybe Chinese growth could actually lag behind EM for the first time, I think, since 1990. I just wonder, it seems like the common denominator is the COVID zero strategy. What do you think could actually force China to ease on that policy front?
So in our baseline assumption is that there will be a gradual relaxation of the zero COVID in 2023. And again, the trade-off between health outcomes and economic outcomes have become much more stark. And with economic activity slowing and with the labor market looking not so great, it's clear that the zero COVID strategy is continuing to bear upon prospects quite heavily in China. right? And so that should, allow, or that should motivate the government to gradually ease these restrictions in 2023. And of course, I think the bigger issue also in China is the real estate sector. And there's clearly the lack of a coherent strategy which can revive confidence in the sector and reduce that headwind.
But, one of the big parts of the negative outlook, I guess that's the way to call it, is that the war in Ukraine is going to keep energy costs high. It's pushing down Europe's economy. Europe is also a very big buyer, certainly of China's exports and for the region's exports. How is the slowdown in Europe going to sweep across Asia as well?
Absolutely. I think even though Asia's direct links with Russia and Ukraine are limited in terms of trade, Asia exports a lot to Europe. To the extent that the economy in Europe slows significantly, that's going to have a significant bearing on Asia's exports, including that of China. So I think that is a clear headwind which Asia has to contend with going forward.
Now, you mentioned the forecast for 2023 for the world is by 2.7%, down 0.2. And isn't it true that for the global economy, when you get to 2.5% or lower, that's considered a recession? You said that the report says, I should say, the World Economic Outlook, that there's a 20 to 25% chance that this could be even worse. What is going to swing the balance?
Well, again, we are focused a lot on downside risks, right? I mean, what if there are upside risks? I mean, there could be upside risks in the sense that what if the war comes to an end sooner than we expect? What if prospects in China improve and the zero COVID strategy is gradually ease, and that leads to a pickup in growth. So you could have some positive factor, but at this point in time, the downside risks are significantly bigger than any kind of upside risk. So at this point in time, it looks almost that almost 1/3 of countries accounting for 1/3 of the global economy may slip into recession either this year or next year.
Your forecast for India. Yeah, Krishna, I want to ask your forecast on India, which was quite interesting, 6.1% growth for next year. That is probably amongst the most biggest economies, a country that's been growing and expanding the most in the world. Why so much, I guess, conviction around India and the growth prospects there?
So actually, we have lower growth prospects for India. And if you look at what we have done for this year and for next year, we've lowered the growth forecast. And that partly reflects the external headwinds and the fact that they've also tightened monetary policy to address inflationary pressures. So that explains the revisions down. And to some extent, what will drive the forecast for next year is they have an ambitious capex plan, which if implemented, and if it also brings along the private sector with it, that could give a boost to growth. So that is the underlying assumption we have for growth in India. And of course, if capex falters, then we could have an issue where some of the downside risks we talk about may come to materialize.
What kind of vulnerabilities, even potential crises, do you see in emerging market countries in Asia, particularly the poorer ones, highly indebted, their currencies are under pressure? The message also from the IMF seems to be that while these many forces like the central bank rate hikes and enduring the strong dollar and its negative impact have to be endured, something needs to be done to help these indebted nations. Is that also what we're hoping for?
Absolutely. I think one thing we've seen in Asia is that debt levels have risen. When I talk about debt levels, I'm talking about public debt levels, I'm talking about household debt, I'm talking about corporate debt. So all these debt has risen across the board, across many countries, and that in the context of a weaker currency, higher interest rates and lower growth is going to have a significant impact on debt. So debt distress is rising. And so one needs to think in terms of whether we have the right kind of framework to deal with debt problems, not just in low-income countries, but also in middle-income countries. So that is something which we have to look out for.